Okay, welcome everyone. I am Itai Goldstein, the chair of the finance department and co-director of WIFPR, Wharton Initiative on Financial Policy and Regulation. Peter is going to take it from here. He's my co-director, and we are absolutely pleased to have you all and host this event on Limitless, the Federal Reserve, and financial regulation in the new era.
Thanks so much, Itai. Delighted to see all of you. I am convinced you are here for Jeanna, but you might be here for pizza. Okay, either way, I'm just glad you're here. We might have overshot on the pizza, so make sure you take a lot of it home with you as you leave. I am so delighted to introduce my two colleagues and friends who are here with me. Jeanna Smialek is the I think of you as the chief Fed reporter at the New York Times. Is that the actual title?
That's great.
Nailed it. Good. The chief Federal Reserve reporter at the New York Times. She has been on the Fed beat for many years. If there is a story you're familiar with in the last 8 or so years about the Federal Reserve, chances are very strong that Jeanna has either broken that story or played a role in breaking follow-ups. Her book is Limitless. The Federal Reserve takes on a new age of crisis. I've read every single book written by a journalist about the Federal Reserve going back probably 75 years. I say that not to brag, just facts. This is my favorite. I think it stands apart in capturing a moment that we will debate today whether it has been superseded by other moments that have happened since the book's publication, or whether the book in fact prepares us to understand what the Fed did well, what the Fed did poorly, and what the Fed maybe did not do that we're still trying to understand. Joining us is Sarah Binder. Is it Binder or Binder?
Today I'm a Binder.
Binder, thank you. Sarah Binder, I'm sorry. Whom I have known for many years, despite my mispronunciation.
I get it wrong myself.
Sarah Binder is a professor of political science at George Washington University, a senior fellow in governance studies at Brookings. Sarah is the leading scholar in the world on the relationship between Congress and the Federal Reserve, author of a wonderful book, The Myth of Independence, about this very relationship. As we will see, Jeanna's focus on this book is 2020, is the seismic tumult of both the COVID-19 crisis, the Fed's response. She does, my one big critique of the book, as you will see, is I think the biggest things that happened in 2020 where that Taylor Swift dropped 2 sensational albums in secret, and do they even show up in the book? Missed opportunity. What she does do instead is focus on Congress and the Fed throughout this period where the technocratic expertise of central bankers runs like a hand into a waiting glove of the political calculations and thinking of politicians, not simply because politicians are trying to serve their own electoral interests and use the Fed only as an instrument, although we see plenty of that too, but because politicians are trying to do right by the public as they see that right. And the Federal Reserve is doing the same. And so what we have here is, whereas in other periods we see a lot of confrontation between central banks and legislatures, the Federal Reserve and Congress, as we have seen this very day in open hearing, in Jeanna's book we see something a little different. There's plenty of confrontation, but there's also a lot of collaboration, and the collaboration invites really important questions for all of us as citizens, as Fed watchers, as market participants, and in all of the other ways that we traverse a world that in many respects the Fed has built. So with that, I'm going to kick it off. This is going to be an open-ended conversation. We'll probably talk for about 30 minutes. I'll have questions going back and forth between Jeanna and Sarah with some commentary from myself. I'm going to stop about 30 minutes through and turn it all over to you. I see some of my best and brightest students in the room, and so I'm counting on you to show off how brilliant Wharton students can actually be. Jeanna, let's start with you. When you started working on this book, if I remember correctly, the idea of a book came to you like March 2020, is that right? Like right in the middle. of everything. We were seeing something that a lot of people continue today when they think about 2020. They may think of it as I do about Taylor Swift, or maybe they're thinking about it as COVID-19, or maybe they're thinking about it as Hong Kong democracy protests or Black Lives Matter. But you make the compelling case in the book that we might have been thinking about it as an absolute barn burner of a financial crisis that wasn't. Can you take us back to the financial crisis that wasn't of 2020? What you saw the Fed do, and why that made you think there's a very big story to tell?
Right, so I wrote an article about this in the New York Times probably a year after this episode that we titled "The Financial Crisis the World Forgot," because I think that we in fact had a financial crisis. They just managed to arrest it so rapidly that we all were able to pretend like it never even happened. So rewind to March 2020. Everybody's shutting down. The government is telling people to stay at home, to shelter in place, to hold off on doing anything until we know more about this mysterious virus that has showed up and is quickly spreading through the United States. There were big economic and financial implications from that. We saw markets absolutely plummet. We saw the Treasury market completely freeze, which does not happen. It's very abnormal for it. It was specifically some older Treasury bonds, what we call off the run, just weren't trading, and when they were trading, they weren't pricing very well, and just the market was very messed up. And so that's really the backbone for all other markets. We were seeing absolutely no corporate debt issuance, even for high-grade borrowers, investment grade borrowers. But when we looked at the high yield corporate bond issuance, companies who are a little bit riskier, you were seeing absolutely market. And so the knock-on effects from all of that could have been just enormous. The Treasury market is the backbone for all other markets. The corporate debt markets are obviously extremely important for companies to finance themselves, to make payroll. We saw a meltdown in money market mutual funds, which are important, again, for payroll, but also just because ordinary people and companies store their cash in them, much like bank accounts. All of these various parts of finance were breaking down, and they were all breaking down simultaneously around mid-March 2020. And so the Fed came in with just this sweeping response through a ton of emergency loans at the problem, and basically managed to stop it by sort of the mid-April period, which was a very Herculean rescue effort. It was surprising how quickly it worked. I think the Fed itself was a bit surprised by how quickly it worked, but it was just a real exercise of their power in ways that I don't think we had seen even in 2008, certainly not at that speed or that sort of magnitude.
Sarah, you take us back to your perspective as a central bank legislator, Fed Congress scholar. March 2020 is remarkable for reasons that have something to do with the financial crisis that the world forgot that Jeanna just described, but also with the fact that at a time that was just a matter of weeks removed from one Trump impeachment and months removed from a second Trump impeachment, we had the largest single dollar amount appropriated by the Congress with overwhelming bipartisan majorities, despite the fact that we had a strongly Democratic majority in the House, a Republican bare majority in the Senate, and a Republican deeply polarizing president. One of the things that happened in the CARES Act, in addition to much else, was the Congress placed the Fed and Treasury in a much closer tether than they had historically been. Can you talk to us about the politics as you see them? How is it that the CARES Act was able to pass at such an electric speed? Question one. And question two, why would members of Congress expose the Fed to so much more political meddling when the theory of central bank independence suggests that Congress, in its wisdom, has sought to insulate the Fed from that very interference?
Excellent questions. So first on the question like commercial speed, for all the reasons you suggested might have been a bit surprising. So, I mean, one possible explanation that I think is only partially true is that crisis compels action in ways that normal politics don't force lawmakers to come to the table. Now, the problem with that, it seems to fit, but the problem with that explanation is that if we look at other crises over time, frequently Congress doesn't actually come to the table, or they come to the table and they get stalemated. And we can all think of various degrees of what counts as crises. And this one certainly counted as a crisis, and they did act. So why do they act in this chance, in this particular time? I think one way to think about what's motivating these lawmakers is nobody wants to be blamed for really bad outcomes. And as Jeanna suggested, right, they're sort of looking at the horizon, both, shut down the uncertainty about what's happening. And neither the Democratic leaders or, I don't know about Trump, but McConnell on the Republican side seem to understand that they don't want their hands dirty, right? They don't want their fingerprints as the ones who held something up. So they claim we're being very statesmanlike by addressing these issues, but really they're just blame-avoiding lawmakers. So just one part is here, this fear of consequences. But the other part is how they knit together this package, which in part was why it was $2+ trillion, which is, sometimes we think in this polarized period, well, they have to meet in the middle, right? They have to have some ideological sweet spot that joins the parties together on a solution. If you look at the CARES Act, that's not what was in the CARES Act. It was the Democrats got their top priorities, Republicans got their top priorities. So for instance, how should we deal with unemployment? Well, one opportunity for the Republicans is, well, let's have the Payroll Protection Act. Let's go straight to the businesses and let them apply for money. Democrats are like, why do that when we can bolster unemployment benefits in ways that were remarkable, even if they varied over the states? Add those two up, no surprise, the package costs so much money. So certainly there's a confluence of forces here that led lawmakers to the particular reactions. On the question of why did they basically yoke Treasury and the Fed together in these responses, I would point to two ways in our book with Mark Smidell, where we think about how does Congress look to the Fed and how does the Fed look to Congress. We talk about interdependence, right? The notion that certainly Congress needs the Fed to act, but the Fed needs political support. They need to understand that what they're doing is not going to be attacked by political forces. So what that CARES Act did in part was to essentially give that political backing to the Fed. Right, we're expecting you to act, Fed, and we're also going to give you sort of a backstop here. We're going to provide those funds so that you can go out and magnify the loans that you make. So I think rather than thinking of it as an anomaly, right, the yoking of Fed and certainly between Fed and Treasury, I really would think of it as sort of consistent with this evolution of the Fed. So in the Dodd-Frank, what does it do in part? It tells Fed, well, if you're going to make those 13.3 emergency loans, you're going to do it a different way, broadly, and you're going to get sign-off from the Treasury. So CARES Act, when the CARES Act comes, it's in the context where the Fed is well aware that Congress is watching how it does its emergency lending, and is well aware they need sign-off.
So let me interject as both moderator and participant in this debate, because I want to bring Jeanna back in on the very debates about this section of the CARES Act, the $500 billion. You reminded me that Elizabeth Warren called a slush fund, I think, at the time, right? I am deeply skeptical of the trend that you're suggesting, Sarah. I think the 13.3 changes in 2010 in Dodd-Frank made me feel less skeptical. I like that the deployment of essentially limitless funds couldn't be aimed at a single institution like AIG. I think that was so toxic to our politics. And I think Treasury sign-off was informal already. We have so few instances of 13.3's invocation, and not one in 2008 where there wasn't cheek-by-jowl cooperation with Treasury. But I hate, with a burning passion, this idea that the Fed, that one part of our government has to invest equity in another part of our government to be able to loan sometimes to third parts of our government. So taxpayer money is protected even though taxpayer money is in the first loss position. And if you're confused by what I just said, I want to welcome you to the modern structure that the CARES Act created. I think it was not necessary, certainly under the laws that pre-existed. The CARES Act itself didn't actually even say you have to do this. But the Fed just embraced it completely, and it was their logic of the thing, which was we're going to put Treasury money in first position because the saying went, we lend, we don't spend, which is another thing that I think is truly risible if it weren't taken so seriously. So I've staked my claim on an outer edge. Gina, what do you think about all this? What did I miss or what did I get right? I know you're going to let me be normative and you be descriptive, but thinking about the events as you document them in the book around March 2020 in that very structure, what can you agree with or disagree with about what I just said? And then Sarah, come and pick a fight with me on this, on where I'm getting this wrong also.
Yeah, so I actually think you're hitting on a really interesting point. For anyone who's not super familiar with these facilities, they are enabled under 13.3 of the Federal Reserve Act. There's emergency lending powers. It can use them in unusual and exigent circumstances. And it is able to basically it has chosen to take a layer of backbone funding, what I think of as insurance coverage, and it's able to lend against that and lever it up quite a bit. That's what we saw happen with the CARES Act. The government handed the Fed a big pot of money, and it took that money from the Treasury and it used it to lend against. I think something gets hugely missed in this debate, including by people who were actively involved in it at the time, which is the Fed told us they were doing all of these facilities on March 23rd, several days before the CARES Act actually passed. There is this huge fallacy out there that the CARES Act somehow enabled the Fed to do what it did in 2020, and that just wasn't true at all. It could already do it. It already told us it was going to do it. I will say the one facility that the Fed did not pre-announce in advance to the CARES Act was the municipal liquidity facility.
Oh.
It did announce Main Street.
Main Street was announced before?
Yeah, it announced that it was going to do the Main. It did not announce the contours of the program,
Yeah.
but it announced that it was going to do a Main Street program on March 23rd. And so I just think this is such an interesting question. There is a bit of a fallacy here that I think is perpetuated by everyone involved in the debate.
Yeah, not everyone.
Not everyone. But I think that it's a very interesting historical point that the Fed just has all of these powers kind of independent of Congress. And I believe technically, correct me if I'm wrong because you two are the experts here, but I believe technically they don't actually even need that Treasury money to indemnify these facilities.
I would take out the word technically. They
Yeah, they don't.
absolutely do
Yeah.
not need us.
And
Yeah.
In fact, in 2008, I think one of them, I'm struggling to remember right now if it was FF or TALF, but one of the money market facing facilities, they used a private indemnification. They got a bunch of the funds to contribute money themselves, and they didn't have the government money at all. And so I think those are two sort of myths that exist around 13.3, that CARES enabled something new, and that this money is necessary as backstop in a way that the Treasury has to contribute.
So Sarah, what do you think? So I'm taking issue with your idea that this is just a slow evolution from Dodd-Frank. I think this is a discontinuity. Where am I wrong on that?
So I guess the question, why would the Fed make these choices that you say aren't necessary? Well, they may not be technically necessary, and they may not be legally, in their interpretation, necessary, but they would strike me as being politically necessary quite a bit, right? Because, and in part, keeping in mind the wake of, Dodd-Frank better than I do, but part of the changes to 13.3, when the Fed eventually wrote the regulations to implement 13.3, there was a lot of references in that discussion to sort of taxpayers and admin costs and so forth. They're looking at the boss. the boss wants to run the show, except when it's not good for the boss. That's Congress is the boss. So I see these as not politicized decisions or partisan decisions. They're political in the sense of how we, as political scientists, think of politics, right? Who gets what, when, and how.
Yeah.
That's a political decision of the Fed.
Yeah, I like that framing. I want to talk about nearly every page of this book. I want to spend just a little bit more on the aftermath of 2020 and then launch into the banking crisis of 2023 and whether we see that as an instantiation of the Federal Reserve takes on a new age of crisis or as a revision of what we learned from Jeanna's book, and then ask Sarah about the politics of that moment too. And then before I turn it over to everybody else, maybe have a chance for you two to ask each other something if there's anything you can ask about. So let's fast forward just a little to the end of 2020. In addition to all of the things we mentioned that made 2020 remarkable, another thing happened in 2020 that was, I think of as, it's almost the same as the US going off the gold standard in an important sense, and that is in August 2020, the Federal Reserve announced that it was going to do take a new approach to its monetary policy making. No longer would it do as it had done for nearly 30 years, which was target at a ceiling an inflation rate. It would engage in what it called flexible average inflation targeting. It would overshoot its inflation target in the name of heating up an economy for all kinds of reasons, but some of which included explicitly pulling in marginalized communities, including those from racial minorities, pulling in more formerly incarcerated individuals into the workforce. Having a greater tolerance for inflation so that we could have a greater society and economy for all. Jay Powell was, by my lights, the most dovish central banker in a Fed chair in the Fed's history from the period of approximately 2019 to 2021. So I want to talk about 2020. I want to talk about the fact that today's Jay Powell has assassinated that version of Jay Powell. There's no overlap between their two outlooks. And I want to understand your sense, Jeanna, as you both reported at the time and as you read about it in the book, and Sarah, your sense of the politics of what could be seen as a very technocratic exercise, but when it's in fact cuts at the very core of the politics as political scientists understand it of the Federal Reserve. So Jeanna, first with you. Talk us through Fed Listens and what you see is really the most, the narrative that you tell us about that leads up to and through the flexible average inflation targeting regime.
Yeah, so I think we have to do a little bit of recent history to understand what the Fed did here. So we come out of the 2008 crisis, and the recovery from that is just very long, very slow. It's kind of steady, but it's not fantastic by any means. You know, wage growth is pretty subdued, unemployment stays high for a long time. Even as unemployment comes down, labor force participation is pretty depressed. And there's this real sense that there has been some sort of policy failure, that Congress didn't step in aggressively enough to re-stimulate the economy in the wake of the downturn, that the Fed, by starting to raise interest rates in late 2015, kind of jumped the gun a little bit, that they didn't push the labor market as hard as they could have, and that we kind of left a lot of potential on the sidelines as a result. And so that's sort of the historical context in which we get what we now call Fed Listens, which is this push that the Fed did alongside its framework review to go out into communities, talk to them about how they were experiencing the economy, and sort of use that as one of many inputs into their review of how they were thinking about the economy, unemployment, inflation, all of these various things that they, you know, have as their bread and butter job. Fed Listens, I think, was very much a political response to a very populist moment in American history. I think Chair Powell came in at a time when Donald Trump, you know, he was appointed by Donald Trump. I think he saw the wave that Donald Trump rode into the presidency and thought there is a huge skepticism of institutions. And I think that because he said it in public several times. Yeah. And so I think that Fed Listens was pretty much a direct response to that skepticism of institutions. It was a way to say, we are going to remake our framework, but we're not just going to do it from an ivory tower institution. We are going to involve you in that process. And they did. They went out and they talked to a ton of different community groups all around the country. I went to a lot of these things. They were very much put on for the media in some way. But they genuinely did, you know, go out and talk to a lot of community groups and sort of reflected on those discussions as they were thinking about their framework. And you saw that in the framework. You know, when it came out in 2020, in August 2020, it pledged to think about unemployment as sort of an inclusive goal, you know, something that they were not being so confident that they knew exactly where that unemployment rate that would spark inflation was going to be. You know, they were basically much more modest about their ability to understand how far they could push the labor market. We saw in September 2020, when they implemented that new framework, that they were much less modest about their understanding of when inflation might take off. They basically assumed that they couldn't understand how strong inflation would be, or the unemployment rate would be, or how strong the job market would be, but they could basically guess that inflation wasn't right around the corner. And that obviously was a fateful decision. But I'm curious to hear what Sarah thinks.
You said September 2020. Did you mean 2021? You meant September late?
I meant September 2020. So September 2020, the Fed released after its meeting
the new statement,
meeting,
yeah.
It released a new statement, and it basically implemented this average inflation target that you just mentioned, And in the implementation, it said that they were not going to raise interest rates until inflation was back at target and we had returned to some version of full employment.
Yeah, got it.
And that "and" was really important. They were basically pledging not to jump the gun, not to raise rates prematurely. And I think it became really important because I think they got pretty married to that promise.
Yeah. I think it's still defensible, but we'll come back to that debate in a second. Sarah, what do you make of the politics of fate?
So I like Jeanna's point in particular about sort of recognizing the populist moment in which they are in, and how, as he's throughout his term as Fed chair, he understands the political predicament of the Fed, right? Which is that the Fed needs political support to do its job, especially when it comes to making tough decisions like raising rates, even if they were months late to do it. So what's going on in that Fed Listens, I think it's important. It wasn't just in Washington, it wasn't in the board. It's this reminder that it is a federal reserve, and that as Fed officials talk about the Fed family, right? Both of these, all of the 12 reserve banks having their own big families, as it were. But understanding that that federal system roots the Fed politically in communities far from Wall Street and far from Washington, and the Fed needs that type of hardwired support. And so trying to rescue the reputation of the Fed in part, keep in mind he just survived a year plus, 2 years of Trump attacks on him personally, but mostly on the Fed. I think that moment is really, first of all, sort of emblematic of understanding what political moment the Fed is in. And just the other thing to keep in mind here, it's also like this reminder that, and we all know, but it's a nice reminder that the Fed is really driven and constrained by the goals given to it by Congress. And when the goals don't conflict, this is fate. I mean, that was, right, this is opportunity to really, for them to go to driving really, drive unemployment as low as they could. Right? But when mandates conflict, that's not so easy.
Yeah, great. Max, we're going to 6:15, is that right? Yep. Okay, so I'm already at the point where I was going to hand it over to you. I'm not going to do that yet. So one other question. That is the banking crisis of 2023. So, you are selling a book about the Fed's extraordinary powers at the very time when the Fed is using its extraordinary powers. Now,
Well done.
some people view the Fed took out its bazooka, didn't realize they were pointing it at their own face, and then pulled the trigger. I won't name who they are. They're co-directors of WIFPR, not Itai Goldstein. So we've got lots of problems, at least that some people see, with the way that the Fed used this extraordinary power in declaring essentially a banking crisis when maybe there were other options to it. So, Jeanna, what do you think? Is this crisis just the epilogue to the book that wasn't written because the book was already in print? It shows what you were documenting in 2020? Or, in fact, is this a story where the Fed somewhat smugly thought, we just killed it in 2008. We were so good at banking and non-banking financial crises that now we have graduated to our PhD in economic crises, only to learn that they skipped kindergarten, which was sort of banking crisis 101 in 2023. So which one is it? Is this the epilogue of the book, or are you thinking, I got to rewrite that in the next edition?
Yeah, no, actually, I feel like, so one of my lines in the book is they're going to use these powers again, so we should be conscious of how they operate, and they're probably going to use them more expansively. So I feel like for a week, I nailed it.
Yeah.
For a week, I nailed it, and then after that, I was dated. So, depending on how you look at that, I was either prescient or I immediately had a book that was out of date. But I think that the really interesting thing here is, one thing, when storyline wasn't finished when I wrote this book, is what the deregulatory changes that were going on during this period, sort of quietly behind the scenes, but were a part of the backdrop that I'm talking about in here, what those were actually going to mean. Because I think you could talk to really thoughtful people on both sides of that question. Some being, very sort of comfortable with the changes that happened. They were pretty surgical. They were, very much, they were important, but they weren't debilitating to the post-financial crisis bank regulation system that we had. And then you would talk to other people who said, no, these were pretty serious. You want to take a look, especially at what Randy Quarles did to supervision. And I think this banking crisis has given us a really great opportunity to do that, take that closer look. So I think there probably is going to need to be an epilogue at some point.
Great. Sarah, how do you look at the banking crisis of 2023 to understand both the technical exercise of the Fed's legal and financial power, legal authority and financial power, and also the political context in which it operates? Any surprises, confirmations, something in between?
First, I think that just perfectly timed. And I think quite well captures much of what we're seeing. And for those of you who haven't peered quite as intently at the book cover as I have, it is not just the Fed, it is the San Francisco Fed. So kudos to whoever and at NOV that precipitated the crisis or foretold it or whatever. So I think it's like emblematic of this question of like what we see historically on the Fed, which is crisis compels cooperation, right? These notions of Fed independence, I don't think they get those very far. I think this is exhibit A of cooperation, and some of it is compelled legally in ways maybe they're too legalistic or not. Some of it's compelled in the law, some compelled by Dodd-Frank by changing both for FDIC authorities as well as the Fed's authorities, but also politically, right? They have, these regulators, it's even more complicated than usual. We have Treasury, we have FDIC, and we have the Fed, and then we have both Powell, and we've got Michael Barr in the supervisory folks, let alone, I haven't heard from Mary Daly, but let alone the significant.
We haven't heard from her on the record. Pretty sure we've heard from her off the record. I'm not going to look at Jeanna as me say that.
She won't tell us.
Yeah.
So it just strikes me this is a moment of cooperation. It's a moment that requires coordination. I am a little surprised at this exact same time that Powell was doing a press conference, that Janet Yellen was in a subcommittee, the Senate Appropriations Committee, testifying. Like, was there no deputy available? But they were asked sort of similar questions, but not quite. They almost gave different answers about this question about. Now that's unfortunate, but it drives home the need for this cooperation and the coordination across these regulators. So how do they respond? So in that sense, I see it as the powers here having to understand the political moment that they're in, influenced by the quarrels and the Republicans' move to pare back. So it fits in my sense of what we look to and what we expect to see from the Fed in these moments of crisis.
So, Jeanna, questions for Sarah? Sarah, questions for Jeanna, and then we'll turn it over to the students.
Yeah. So I think one thing that I'm really interested to hear from you, Sarah, is what you thought of the way that the Fed recast the employment side of its mandate in 2020, because that did seem to fit into a political moment, and I wonder if that stuck out to you in any way or how you thought about
the appointments? Or
no, the unemployment. Sorry, the unemployment.
Yeah.
The unemployment rate in 2020.
I was a bit, in some ways, surprised, right? They really went all in on the unemployment side. But I think in part they're able to do that because there's expectations, as I understand it, of low rates, low growth, and low unemployment as far as the eye could see. And in that context, if the struggle is to get inflation up, then burning the unemployment, burning job markets so hot, I think they thought it was fulfilling both of their congressionally given goals. So but just 1 year later, it looks quite different. But I think they took advantage of the liberty they had to push hard on employment.
Questions for Jeanna?
Okay. Who named the book?
The publisher, as you might imagine. Yeah, everyone keeps asking me that. Also, who chose to put the San Francisco Fed on the front? You're the only person who's had nice things to say about that choice.
Oh yeah. Listen, here's my story why you fared so much better. My publisher for my book, Power and Independence of the Federal Reserve, the friggin' Treasury on the cover. And when I said, that's not the Fed, and they said, no, but it's from the $10 bill. It's like, don't care, that's the Treasury. And they said, too late, and then it shipped. And one person asked me about it, said, that's the Treasury? And I was just like, Until 1936, the Fed was located in That's my story. I'm sick. And also, there's a story about the relationship between the Fed and the Treasury. It makes sense. Stop asking questions. Why are you being so rude? So this is actually better than what it could have been. I like the title.
So I think you make the case for the limits on the Fed. I actually think you do a stellar job appreciating from your reporting, especially like all these political pressures that weigh in on Chair Powell and the Fed and the regional banks. And so that was just surprised by the title. I think you make just like a very square account, especially at the end, as I mentioned before we started, right? Asking that question, like, what type of, like, what is the expectations for this Fed? Is it the hands-on or is it hands-off? And you sort of describe all these political pressures that make that so hard for Jay Powell and why he goes in the middle.
So is your next book called Limited?
Like Peter, I have developed a post hoc justification. But actually, so I was they didn't leave me entirely out with no veto power over the title, although they did not like any of my ideas. But I do think that Limitless makes some amount of sense for the argument I'm making in the book, which is that the Fed has a limitless ability to print money effectively. Obviously, lending, not spending, we know all the rules. But they have this limitless balance sheet, and that is politically extremely tempting, for a lot of people with power in our society, whether that be a lobby or a politician. And so I think the point that I'm making here is that we just need to be conscious, and this probably needs to be part of our civic education, that the Fed does this. Like, I think people, when you ask them about the Fed, probably have some sort of idea that, there's some macroeconomic management tool going on there. But I don't think most people would know that the Fed can, come into corporate bond markets on a bad day. I think that it can do it. Certainly, people don't know that it can go and lend to municipal governments. And so I think the Fed's powers are a lot less limited than most people probably understand them to be, and so that's why I'm comfortable with the title.
Okay, so I'm 10 minutes late, and I have decided to ask 5 more questions. No, I'm just kidding. Now it's your turn. So, show of hands and introduce yourself and fire away. Please.
Hi, I'm Aryan. I'm a current junior in Wharton. My question is, it has been noted that the independence of the Fed has significantly increased from the 1950s under the Truman administration trying to bully the Fed to the recent Trump administration not having significant effect on the Fed. So what more steps do you think we should take to increase the independence of the Fed from Congress and the current president? And to that end, do you think lifetime appointment of boards and chairs is a potential good idea?
Feel free to beg the question about whether we even should do such a thing as that.
I'll just take half of your question. So when Mark and I wrote this book about the history of the Fed, we hone in on that 1951 point. Our argument is that it was a divorce of the Fed and Treasury, but pushed the Fed almost closer to Congress, right? Almost made Congress's job easier now that the Fed could actually control, right, the monetary policy. Is there well, let's take the lifetime appointments. Let's put it this way. I don't know that lifetime appointments have necessarily sealed off the Supreme Court from the world in which they live. And so I don't know how much hope or trust to put in lifetime appointments for insulating the Fed from political pressures, because it is quite like if we were to stack up all these independent agencies on how insulated policymaking is and the staggered terms, like what protection from politicians they have, the Fed would be maxed out compared to other agencies. And so it is really quite, quote unquote, independent compared to other bodies. So I don't know quite what added benefit one would get from stretching out the terms, for sure. But it's an interesting way to kind of think about what might be tweaked to generate a different set of policy.
And I would go further. I see enormous costs. I'm finishing a political history of the Fed, and I look at 51 a little bit differently. I look at it as a major rupture, but of undefined terms as it happened at the time. And certainly you can't follow a through line from 1951 as this nadir of independence through all the way to Jay Powell standing up against Trump the bully. The Fed has bobbed and weaved sometimes quite insulated from presidents and even coalitions within Congress, sometimes quite exposed to those. And I think another word for that kind of politicization, not partisan politicization, which I agree with you would be quite dangerous, is democracy and accountability. It is good for us that with Joe Biden as president, his appointee, Michael Barr, is standing up and taking heat for his administration's decisions to bail out the uninsured depositors of Silicon Valley Bank. It's good because Michael Barr and Randy Quarles, his predecessors, see the world very differently, not just because they have different expertise. They have actually pretty similar expertise. They speak the same technocratic language, but they put a lot of different value judgments on different ideas. And the value judgments of Michael Barr are closer to the sitting president. And that's good. It's good because elections have consequences, as they should. Jeanna, what do you think?
Yeah, I'm gonna follow up that by asking you a question, which is, it seems like there's a huge difference there when it comes to the vice chair for supervision and bank regulation on one side, and the vice chair, the chair of monetary policy on the other. And I wonder if you think it's equally appropriate for all of those roles to be close to the president.
Yeah. For those of you who want to understand that better, Jeanna just wrote an article on this front just the other day, right? It's about this very idea. I think that the counter-cyclical Ulysses contract time and consistency dimension of monetary policy independence has been oversold. I think that there is an awful lot of political content in the way that Sarah has described it in the decisions of monetary policy, including and perhaps especially in the regime changes that we see in August 2020, and that the Fed is just months away from announcing they're going to undertake yet again. I think that the counter-cyclical time and consistency Ulysses contract elements of financial regulation has been undersold. I think that we should want to have mechanisms to smooth cycles, not because we want to insulate people from electoral processes, but because if we're going to be whipsawed by elections with respect to how we manage the capital structure of our largest banks, then we're going to have a pretty messy and incoherent financial regulatory system. Congress, interestingly, has insulated regulation and supervision from political action in all kinds of ways. I say that Michael Barr, it's good that he reflects the priorities of the president. Michael Barr was not the vice chair for supervision until July 2022, right? 18 months into President Biden's term. And during those 18 months, vice chair for supervision was either Randy Quarles or Jay Powell, de facto. And so we've got some of that staggered terms, the long terms of the governors who have regulatory and supervisory roles as well as monetary. I'm dodging your question. Do I think there is meaningful difference there? And I think there is. I think the case for insulation on monetary policy is stronger. But my point is that it's not that weak on regulatory and supervisory matters, and it's not absolute in monetary matters either. All right, students. Yes, please.
Hi, my name's Kevin, first year MBA, former student of Professor Conti-Brown's. My question is more on the second order effects of what's essentially a more trigger-happy Fed on the creditworthiness of the United States and the US dollar, because I think back to like 2011, the downgrade there didn't really change anything, but is this potentially an inflection point in this, or is this just business as usual? The US is where it is.
Jeanna, let's start with you on that. What do you think? You cover in your book briefly, but some of the intense politicization around QE, and QE received some gasoline from the fiscal dysfunction. Bernanke was quite clear about that he thought the playing games with with fiscal commitments meant that the Fed needed to step up where politicians had stepped down. A very remarkable event in the Fed's history. He did this in front of reporters. So what do you think is the Fed too trigger happy with its willingness, if I can put some words in Kevin in your mouth, with either its willingness to absorb all of this fiscal capacity, or in the case of crises, to step into the breach and by consequence expanding its balance sheet? Does that threaten dollar dominance?
You know, I think that these questions are actually yet to be answered. that sounds like a dodge, but I'm a journalist, so I don't have opinions. No, but genuinely, I do think that is the case. I do think we're actually approaching a really interesting moment to test this theory, though, in the sense that I think, I'm obviously a reporter, I spend a lot of time talking to people. It doesn't seem like the debt ceiling is headed for a tidy and clean resolution this year. And it does seem like a lot of people in financial markets are relatively taking for granted that the Fed is going to step in and do something to fix that particular problem. That if we pass the X date, if we get to the point where we have to worry about these issues, the Fed has some sort of plan and that it can fill in the gaps in ways that will make this not catastrophic, just kind of bad. And I think that those kinds of things are real questions. I think if anything's going to force me to write a serious epilogue, that will be it. Like if the Fed as a safety net is the thing that makes lawmakers feel comfortable not doing something as basic to their jobs as raising the nation's borrowing limit, I think that would be a very interesting moment.
I would just add on, and I don't know whether this way I think about the Fed and Congress will apply to the debt limit moment, but I think of it this way, which is Congress knows that the Fed knows that Congress expects the Fed to act, right? And that expectation, the Fed, because of its broad powers, often just shows up with those powers. They know they're expected to do that. As Jeanna said and written, right, it's not entirely clear what the Fed can do, especially on prioritization and so forth. But if it comes to shove at the brink, I don't know. But I wouldn't be surprised to see some of those tabletop exercises that they did in 2013 or so come out for real.
Henry.
Hey, I'm Henry Barry, second year MBA, taking a few classes with Peter, so happy to be here. My question is actually about like the change that happened in 2020 when everyone thought inflation was totally dead and you can let unemployment get as low as possible. Do you think that viewpoint is kind of over with inflation staying persistent, that they're now like, okay, if employment gets so high, we really do need to hike, regardless of if inflation's already picked up?
Remember the Evans rule? Yeah.
So this has been a deep confusion of mine as a Fed watcher, I will admit, because the 2021 inflation, the inflation that the pandemic gave us, we'll say, didn't have a lot to do with the unemployment rate in my mind. Like the things that gave rise to this inflation were really the collision of constrained supply chains and quite a bit of government stimulus that all happened at the same time and collided. And that gave us inflation, and then the inflation became more persistent as it lasts, as over time it sort of bled into wages, et cetera, et cetera. The thing that was really interesting to me about that is none of it seemed like a classic Phillips curve story. Like, I guess you could possibly make an argument now that the reason people are getting the wage increases they're getting that are helping to perpetuate inflation is because the unemployment rate is very low and workers do have some degree of bargaining power. But in a world where you don't really understand where labor force participation should be, that almost seems like a weird argument to make too confidently to me. But it has, so I say all of that as my initial caveat that I'm then going to follow up with, but the Fed does seem to think that there is some sort of Phillips curve story happening here. Like when they talk about the situation today, they will often say something to the effect of, well, clearly unemployment is too low, and I'm speaking mostly about the regional reserve bank presidents who come out and say things to that effect relatively often these days. And that was very out of vogue for a minute, and it seems to be back in vogue. And I can't fully square that. I've asked a lot of them about it, and I haven't satisfied myself intellectually for where that came from. But I would say that sort of as your question implied, it does seem like that momentary move away from feeling confident about our ability to estimate the natural rate of unemployment at all, that seems to have gone away.
We are at a return to classic monetary politics in a way that the 2010s confused us and maybe convinced us that the strange bedfellows in monetary politics had triumphed. Classic monetary political coalitions are Republicans and conservatives concerned hawkishly about inflation, and Democrats and liberals concerned dovishly about unemployment. In the 2010s, we had all kinds of strange swirls where the Fed was getting hammered for being too inflationary, that had a conservative bend to it, but had a populist conservative bend. So it was very hard to identify. What we're seeing is severe political consternation coming at the Fed for being too dovish. And today, we are seeing people like Elizabeth Warren calling for Jay Powell's job because he's threatening to get 2 million people out of work before he'll feel satisfied that his job is done. A version of that inquiry that I think is really important that Jay Powell mostly dodges today. When he's asked about this, he says, but inflation is bad too. And it's a kind of whataboutism that I think he hasn't quite grappled with in public, although I'm quite sure he's thinking about it a lot in private. And that is to say, it's a version of your question, Henry. When will we know we're done? How many people unemployed? With what consequences for their children? With what consequences for their communities? When do we get to ring a bell and say, inflation's over, let's now tackle this recession that we caused? The person that Jay Powell has paraded about as his great, the angel on his shoulder is Paul Volcker. Paul Volcker was singularly terrible at this balance. He imposed the greatest recession at the time that the nation had seen since the Great Depression. And it destroyed communities that to this day have not rebuilt. Gary, Indiana, Milwaukee, Detroit did not survive the Volcker recession. And so the question that I have, I had said before that if Jay Powell succeeds at disinflation without recession, it will be the single greatest feat in US central banking history. I should have said also without a banking crisis. I think that his legacy might, the first pages might be written now. But I still wonder about this, and I wonder whether he knows or his colleagues know when the Fed should be satisfied. So what do you think?
I'm ready for the next question.
Okay, great. Next question, please.
Hi, my name is Anisha Anand. I'm a first-year MBA. I was wondering if you could speak to the school of thought of the Fed intentionally maintaining the low-rate environment really to the benefit of the financial markets, the leveraged loan market, the private equity world, and how that balances with what you were speaking of, the commitment to employment. And if you think it counters that, balances that.
Great question. Maybe I'll provide a little bit of context, then Jeanna, and then Sarah. This is another place where the politics got scrambled, right? So one of the critiques of quantitative easing came from what you might call the hawkish left. So people not on the right, but who were thinking that by keeping rates so low for so long, the Fed was in fact giving a ton of free wealth and increasing wealth inequality by rewarding the holders of capital. And a lot of prominent people who feel this way, there's an entire book basically written about their story. The Lords of Easy Money. Talk about titles that I hate a lot more than Limitless. So without implicating you in my dismissal of that book, Gino, can you comment on your thoughts about the economics and politics around this, and then Sarah too, if you want.
Yeah, so I actually have a chapter kind of addressing this issue in my book. I think there's a beguilingly simple story that you can tell about quantitative easing and low rates, which is that when you have low interest rates, it's great for venture capital, it's great for equity markets. Like, we can see all of these things and say they're probably true. And I think that you can say, hey, look at the Fed, they're a bunch of finance guys, they came from the finance world, they must be helping out their buddies. And it seems to, like, at a surface level, I can see why that makes a lot of sense and why that story stays around. I think that having watched this institution for a long time, I've covered them for years now, and I've spent a lot of time sort of looking out for any sign that basic narrative is accurate. I don't think it is. I think the way that they think about both low interest rates and quantitative easing is that by lowering interest rates and sort of getting capital to circulate, they can help to foster a stronger job market at the end of the day, that they can sort of like heat up the economy when nothing else is. I certainly think, to Peter's point earlier about Ben Bernanke and when he sort of unveiled quantitative easing as a monetary policy tool and not just a financial stability tool, very much thought of that as stepping in a void where Congress wasn't stepping. And that's not the way, I think he's a sort of consummate academic, that's not the way you would do it. That's not the way you couch it. I think what you were aiming to do is help private equity companies. And so I think that just sort of the actual sort of documentation of how these processes have played out, it always seemed very much more about the macro economy than the financial economy to me. That said, clearly there are side effects. I think it's really important to think about those side effects holistically and not just look at it as it raises the unemployment rate or it raises the S&P 500 and so it boosts the rich. I think you also have to think about the fact that it raises the employment rate and so it allows people who might otherwise not have had any money to build some savings. And so I think you do have to think about all of this as a system, and it's devilishly hard to figure it out as a system. A lot of people have tried to quantify the inequality effects, for example, of monetary policy, and the papers find vastly different conclusions because it's extremely sensitive to your methodologies.
Yeah. Sarah, what do you think?
The only thing I would add is just to put a finger on the fact that it was a housing crisis that's helping to generate the financial crisis in the first place. And I think part of what the Fed was up to with QE was to have the impact to lower mortgage rates and other related rates. So the charges that it was crossing from within the Fed, that the Fed was crossing boundaries into credit policy and fiscal policy, whether that was true or not, those were choices made, I think, directed to the type of crisis that was prevailing. And certainly there was pressure from the Democrats certainly during the Obama years to do something more about about the mortgage crisis, even when Congress wasn't. Does it work?
Is that Chris, your hand?
Yeah. Hi there, I'm Chris Hughes. I'm writing a book on the history of financial markets and about to join the PhD program here in the fall. So I was wondering if you could talk a little bit more about where we started, specifically the intellectual origins of a lot of the facilities that emerged from that March 21st, 22nd weekend in the midst of the pandemic. Both narrowly, I love the book, I thought it was excellent, but I found myself looking back to see if I'd missed something, to understand where did all of these programs come from? Were they just Mnuchin and Powell cooking them up, or were they evidence of a longer term effort by staff to prepare it? So I'm curious about that in the narrow sense, and then also broadly now. What's your sense of how they're thinking about other emergency facilities to deal with treasury market illiquidity or other things like that?
Yeah, so that's a good set of questions, which I'm going to answer in a very abbreviated fashion, but I have many thoughts about this, so we can talk about it offline at some point. But yeah, so huge array of facilities came out of that March 21st, 22nd weekend. A lot of them were totally new. The Main Street program was totally new. The corporate bond facilities were totally new. A lot of that was sort of, they had done quite a lot of planning for that weekend in the days ahead of it. So I think Andreas Leonard, sort of the staff level at the Fed, had already done quite a lot of, as they would say, filming the runway to plan those facilities. I think there was a lot of bilateral negotiations. I think that was a pretty good reason, because if you read Mnuchin's calendar from that weekend, he kept the good thing about Mnuchin, he's very punctilious, so he kept a really, really detailed log of all his calls, and he was calling Jay Powell every 5 minutes, which I don't know what these conversations were, but, and so I think we know that a lot of it was done probably bilaterally between the two of them. Obviously, these parties tend to not disclose that much about how the sausage gets made. So that may be a fact that's never exactly known to history, like which specific details they each figured out, but it seems pretty clear that they had it a lot. Yeah, that's the abbreviated answer.
Yeah, there were documented requests by the Fed to the Treasury to we will create 13.3 facilities in the 1990s. If you let us use the Exchange Stabilization Fund as a buffer. And the Treasury said, go to hell, essentially. Like, why would we ever? Ironically, soon thereafter, the Fed then bailed out the Treasury when Congress restricted further Exchange Stabilization Fund for currency stabilization to help out our largest trading partner, Mexico. This has been a part of the historical conversation for many, many years. When push comes to shove, an emergency belongs to the government, and the government tends not to differentiate in those kinds of crises. And yet, the the lawyers, central bankers, and politicians care enormously about the term sheet of that shared responsibility. And I think we're seeing that again in this incredibly bizarre invocation of 13.3 over the last few weeks. And I think we'll see it again. So that's the friendly amendment I would make to the limitless conclusion. We will see these tools used again. And when they're used, they're not going to look exactly like they were the last time. And with that, join me in thanking Jeanna Smialek. For hours longer, and if you feel the same way, then come to future WIFPR events, because we've got a lot cooking.
No.
That was awesome.
Yeah,
Yeah, I mean, my account, so I don't know.
Yeah, I'm assuming.
It's your schedule, right? And we recorded that, right, James? Were we recording? Were we recording? I think so.